So quick to think that we're right, but so slow to admit that we're wrong. And this can be seen every time we have a winning trade versus a losing trade. And as we go throughout this document so far for what I've written, you'll see that, it's an issue that all of us go through. But today, again, we'll be talking about when and how to hold runners. Primarily for this part, we're going to talk about when to hold runners. The more in detail part is how to hold runners, which is going to talk about not only like strategies, but trimming indicators to possible indicators to use, momentum and so on and so forth. Before we move on, just remember the usual disclaimer. The information we provide is for educational and informational purposes only. We're not licensed financial advisors, tax professionals, or investment experts. And any discussions about trading stocks or options should not be considered as financial, tax, or investment advice. You can feel free to read that if you would like. But we're just going to go on ahead and move on. So today, we're just going to talk about what are runners, why they're important, and when to hold runners. The third part and the final part is so long itself. Again, we're going to go over that on Thursday, which is how to hold runners. So what are runners? You'll be surprised. Not a lot of people actually know that. Runners is basically a term used for small remnants of a position left over from the original position. These runners are left to capture more potential profits. Basically, an example, let's say if you enter original positions of 10 contracts at the entry price of $1.50, and then it goes from $1.50 to $1.80, that's around 20% profit, right? If you trim 6 of those 10 contracts for 20%, you'll be left with 4 contracts, and those 4 contracts are considered runners. Now, there's different terms such as runners, right? Then there's risk-free runners. Basically, what risk-free runners are, which is going to be talked about more in the how to hold runners part. Risk-free runners is where your profits from the trimmed positions will completely outweigh any potential loss from any remaining position. So just so you can understand what that means, let's say, you have 10 contracts at $1.50, same thing. And then they end up going to, let's say $3.50. No, let's say $4, okay? That means your profit's gonna be, what is this? 250. So per contract, your profit is $2.50, which is $250, which means you could theoretically trim 9 or 8 of the contracts that you have in that position, and the remaining contracts that are left, even if they were to go to zero, doesn't mean you will make them go to zero, will be there, and you allow those to run to an amount that whatever, but that's the concept of risk-free runners. It's basically where the runners that are left will not hurt any profits that you have, so that no matter what, that position won't end negative. Now when you do hold runners, there is a possibility you could end up red. We've seen this before. There's been times where I have or you have trimmed the position at 10 or 20%, and for example, the stock just ends up going the opposite direction of our trade, and then our overall position ends up negative because of the runners that we have left. And even though we trimmed at previous spots and we quote unquote secured those profits, the runners work against us. So again, that's going to be something we get deeper into this live session primarily tomorrow. So why are runners important? This is something you guys need to understand. Holding runners are a risk as you're risking current profits and more, right? So you're risking your current profits. So if it's up 20%, you're risking those profits and your original capital that you put up. The upside, though, is increased potential profits you can attain in a winning position. The potential profits captured in runners can help accounts grow quicker, as your winners will be larger than your losers if done right. What do I mean by that? A lot of us have the bad habit of holding on to our losers a lot, right? Sometimes, we'll get into a position and we'll just hold it to like 30%, loss for no reason, just because we hope that it's going to work out. And then, eventually, let's say we stop out at 30%, but then our winners we take out at like 20% and that's it. How does that make sense? That doesn't make sense. That's not how you grow an account. That's where everyone always struggles. No one ever thinks like, everyone always has this huge mistake where they're like, oh, it's a winning trade. Let me just capture some profits, right? Or they might think, oh, I've been losing so many trades till now. Let me secure some profits. Look, securing profits is not the wrong thing to do. There's a saying that says, you can't go broke taking profits. That's somewhat exaggerated, right? Because that's only talking about your profits. What about your losses? If your losses are even as small as negative 30% each and every single trade, but you're taking profit at 15%, if you're a novice trader, your win rate's not going to be high where your winners completely outweigh your losers, which is why win rate is not important. And this is going to tie into what we're going to talk about today. A lot of people are obsessed with win rate, and win rate is not important. For you, for me, for anybody who trades, the most important number you can focus on is average percentage gain. Because that shows you if the trades you're getting into and the trades that you're holding outweigh the trades that you have that are losers. As long as that's the case, you can have all these severe cases where someone can literally have a 40% win rate and have an average gain percentage of 60% and still be profitable in the end of the day. And the biggest reason why is either two things. One is either they're holding runners, or two, they're just sizing very small and holding their position. But anyway, moving on. The truth that no one wants to hear. For me to be a trader who always holds runners, I need to accept the fact that some positions will end up at break even or even at a loss. But that's okay for me. I'm willing to sacrifice small profits for larger potential profits. You have to be okay about losing. You have to be okay with not being right all the time. And you need to know when to hold runners. Again, what I'm talking about is everyone's too obsessed about being right. No one gives a crap about if you're right. Your account doesn't matter or care if you're right. The only thing that matters is you end the day or you end your whatever trade green. And if you're ending the trade green, the next thing that you have to worry about is if you're ending the whole week green. And then if you're ending a whole month green, and it goes on and on. And how do you worry about ending your whole month green or your whole year green? It's not by worrying about how many times you were right. It's worrying about the fact that have I been making sure that the trades I hold or I enter are, one, executing to the plan that I want, and two, if I'm holding the position to the plan that I want it to go to. For example, let's say that I enter at, XYZ calls. That's the $70 strike and the stock is at $68. And I'm thinking, okay, I'm taking this day trade. I want to, trim majority of my position by 68.50. I should make sure that I hold my position. This is just hypotheticals. Again, it's my perspective and my opinions. I'm not a financial advisor. I would hold the calls till it reaches my point, and then I'll look to trim majority. Especially if I had to start off with a very small account. Small account meaning, let's say $5,000 to $25,000. Because the truth is, if I'm not building myself a habit of sticking to a trade plan, which ties in heavily about holding runners, if I don't stick to that, then I will never be able to hold my trades to full potential. How many times have you taken a trade? And I'm not talking about all the dumb times where you're like, oh, I should have held that and it was just went up when you didn't expect it to go up. I'm not talking about, abnormal events. But how many times did you actually, have a price target in mind, whether it's on the stock or whether it's on the option contract, and it was a valid plan, and you didn't hold it because the thought in the back of your head was, oh, $50 here is good profit, or $100 here is good profit. Let me just, close my full position. No, dude, that's not gonna help you out. I've seen so many people have that thing, and the only time where that mindset prevails, and I'm being truthful with you, is when you have a big account. Then you can be like, oh, let me take profit at 5% and 10%. But when you have a smaller account, especially sub 25K, taking profits consistently, full profits, I'm not talking about trimming, full profits at 10% and 20%, when average losses are around 20 to 30%, right? Usually that's the loss that everyone faces with. It's just unsustainable. And that's why so many people, they have one great year where they're taking profits, full profits at 20%. They have sometimes where they hold it, but then they end up not surviving the year after that because they don't realize that they need to be able to follow a plan all the way through. Moving on. So now we're going to talk about when to hold runners. The importance of knowing when. You can't attempt to leave runners for every single trade that you're in. Leaving runners in the wrong trades will just hurt overall P&L, right? So your profit and loss for that position. The decision hinges entirely on the type of trade you're in, your conviction, and current price movement. And you need to identify this. So what do I mean by this basically? Very simple. I mean, it's pretty simple if you just look at it. Every single situation is different. Unless you are a person who sticks to a certain one single trading style and you just wait for one single setup, and I'm talking about one single setup, then your plan could be static. But in the long run, no one just sticks to one single setup. No one just trades the falling wedge and hitting the certain fib level and then they take a trade, and that's not how it works, right? It's impossible to have the same thing over and over again in the market. It's just like snowflakes. Every single snowflake is individually different. I don't know why the hell I went to snowflakes, but we went to snowflakes. Raindrop doesn't fall in the same spot for like hours on end, right? So it basically you have to treat the same way when it comes to trades, right? Each one is unique, and you have to realize that you need to be adapting to what you're looking at. And we'll go over like the certain possible criteria you could look at, right? But the reason why I'm stating this is because everybody will be like, oh, I'm going to get into a QQQ call, and that might actually in reality be a scalp. And they're thinking, oh, I need to get like everyone always thinks of risk to reward, when I don't think people truly understand what risk to reward means. But they'll be like, oh, let me get a 2-to-1 risk to reward. So they're risking $80 to make 160. But the thing is, you're scalping. You can't be looking at risk, 2-to-1 risk to reward. It just doesn't make sense. It's not like it's not going to work out, but you're not logically thinking of the situation that you're in, right? Because every situation is different. Scalp trade is different than a day trade, and swing trade is definitely different than a scalp and a day trade. It is much easier to hold runners on swing trades compared to day trades, and it's way easier holding runners on day trades than it is to scalping. So you need to figure out each and every single trade you're getting into. Am I getting into a scalp? Am I, for example, what I mean by that, and we'll get into it. What I mean by that is, let's say for the past 2 months we've been extremely bullish. Let's say you're trading 0 DTEs, and you're trading counter trend, which means the stock, the QQQ is going up, for example, or SPX is going up, and you want to take puts. All right, that's fine. To each their own. But realize when you're getting into that put, you're counter trading. You're trading against a trend. So, your probability for that trade working out in the first place is pretty low, which means your probability of the trade running out or longer to the price points you want it to go to is even lower. Versus a day trade, let's say, you guys have always, one of my favorite setups in day trades is a base. So it's something where, the stock price comes down, consolidates, it kind of doesn't really make lower lows, try to make a higher high, doesn't, but it's still remaining bullish. Day trades are better to hold runners compared to scalps. Because when you have formations that has times to develop, then you can be able to have a little bit more confidence about holding your runners to holding it to certain points that you want to reach. So you have to figure out what kind of trade you're in. A lot of the things that we're going to go over today and on Thursday will basically reiterate how important it is to have a idea of a trading plan before you enter into any single trade. Because there should be no reason that you should not have a trading plan before in every single trade. You could see that with me, for example, when I even enter into a trade, I always set my trims. Sometimes I don't set it out because, the trade just moves too quickly. I can't post it. But you need to realize how important it is to have a trade plan, and you need to think of these things beforehand. And it's so simple. People think it's so time consuming, but it's not. You just need to ask yourself the right question. You need to ask what you're trading, right? That's very important. Are you trading yourself a mega cap stock? Are you trading an ETF? Are you trading something liquid, illiquid? Right? Stock or ETF, right? And next thing, are you trading weeklies, 0 DTEs? Are you swinging? And then the second you answer those 3 questions, you already know what kind of, trade you're in? Is it a high volatile market? Are we, just climbing slowly up? Are we shooting straight up out of nowhere? Once you are able to ask these questions, these things become a lot easier for you. And I encourage that you should be thinking about these things. And if sometimes you thinking about these things makes you miss out on a trade, that's fine. Because you've heard me talk about this over and over again, where the market, if the world was, there's no reason you should be trading as if the world's ending tomorrow. Because in reality, if the world was ending tomorrow, and, Israel did the Samson option and just nuked all the countries in the world, money wouldn't matter. So you have to make sure you realize, like, hey, it's okay to miss out on stuff. Just similar as it's okay with telling yourself it's okay to be wrong. As long as I figure out if the trading plans I'm looking at are good enough, which means you're holding your runners, you're trimming it at right places, right? Again, none of what we're talking about today means that you don't trim. I'm not talking about not trimming. What I'm talking about is fully exiting a position and completely capping your gains to the upside, which hinders your account progress and explosive growth, which again is the most important thing, especially with an account that's smaller. Now, things you have to realize. The smaller your account is, the harder it will be. That's just the truth, especially if you're sub 5,000, especially below 1,000, you're already setting yourself up where you're going to be either one, using most of your account for one single trade or one single contract, and it's just a lot of volatility. The market is not set up for smaller accounts, and I know people have had luck trading cheaper 0 DTEs, and props to you. I have nothing against that, but just do know the time we're in terms of the market and the way it's moving is irregular, and everything always reverts back to the mean. So that doesn't mean the progress you're having right now is unreliable or illogical. It just means you need to be prepared for when it reverts back to how it's going to be. So even though you might be succeeding right now with a small account, or even if you're not, it's not going to be easier to hold runners. It's going to be working against a lot of your emotions. It's going to be working against your capital. And it's going to be working against the whole take and profit thing, right? So you have to figure out when it is reasonable to take profit and when to hold runners and stuff like that. Cheaper cons are not the solution to holding runners. This relates to a lot of smaller accounts. What I mean by this, let's say, for example, we're looking at Tesla calls. We already know Tesla calls are naturally expensive. At the money calls are around $4 to $6 depending on the day of the week. And 20 Delta calls, which are a little bit out of the money, are already like, they're $1.50. And $1.50 is cheap, but people find that expensive. That doesn't mean you go from $1.50 to 75 cents just because that's what your account can afford. This also ties back to the whole risk management video that I talked about. The cheaper contract you go, the more risk you're putting on yourself. And of course, there's the whole saying that, higher risk, higher reward. Can't argue with that. But also, you're starting off without an edge with a smaller account. And you're putting yourself at a lower edge by getting a lower delta call, which basically means, in simpler terms, out of the money call. And you're going to kind of screw yourself if the trade doesn't work out. So a lot of people, what I mean by this is a lot of people will say if they can afford to buy like two contracts that are worth $2.50 on Tesla, they won't buy that because they're like, oh, I want to buy, multiple contracts so I could trim. So I'm not going to get the two, $4 contracts or $2. Okay, geez, let me write down this example. Let's say they could afford $2.50 times 2, right? So they can afford $500. But in their head, they're thinking, oh, I'm just having 2 contracts. That's not enough for me. I won't be able to trim as much. So I'm, instead of buying, 2 contracts that are worth the $500 in total, I'm just going to buy, 5 $1 cons, which would equate to the same amount, which is $500. You might be thinking in your head, oh, that's going to give me higher percentage if it works my way, right? So for example, if Tesla went up and we got these calls, the calls that were worth, let's say this is the let's say this is the 330 call, and this is the 335, right? Whatever. No, that's probably going to be realistically 345. right? So this is farther out of the money. At the money is all the way on the top over here. Your thought process might be, oh, if I get the 345 calls, my delta is lower. But, if Tesla goes my way, then the percentage is going to be higher. Yeah, for sure. You will gain a higher percentage. I can't argue with you. But then my question to you is, what if it doesn't go your way? Then you're going to be stuck with that contract decaying already because of theta. And let's say even if it's in Monday and the theta is not as high as, let's say, Thursday, you're still going to be losing value because the delta is going to decrease at a rapid rate compared to a call that's the 330 call. So people think that, oh, because I want to hold runners and trim, I need to buy $500 worth of $1 cons versus two cons of $2.50, which equate to the same value. With one way, you're giving yourself safety, a little bit of safety, and you're also giving yourself higher delta. And the benefit of having higher delta is the contract says they don't gain percentage as much, but they gain, what's a dumb way to put this? They gain money value quickly. So what I mean by that is, these calls over here, the 345s can go up 35%, that's fine, right? Meanwhile, these would just go up, let's say, 20%. But you might only get, let's say, let's just say, for example, I can't do the math until you might only get like $150 profit from this. But from this, you're getting like, let's just say $200 profit. I'm not doing correct math. That's a shame since I'm Indian. But you get what I'm trying to say. So just because you want to hold runners does not mean you have to go farther out of the money to afford more contracts. In my opinion, depending on what you're trading, it is much safer in the long run to get contracts that are reasonably at the money and also a good distance away from being at the money. Because when you're day trading, you don't always want to get the contract that's at the money because you're kind of limiting yourself. So you want to get a good mix of high risk and low risk, which is around usually the 30 to the 40 delta, depending on what kind of stock you're trading, right? So just keep that in mind. Yeah, more cheaper cons does not mean that you're putting yourself up in a position where you could trim more and that's going to lead you to success, where you can hold contracts or hold runners that goes like 150%. No, it doesn't work by that, because here's the one thing that I forgot to talk about. Cheaper cons lose value quicker. So you can hold the runners on the expensive cons longer than you would be able to hold the cheaper cons. Because what I mean by that is, let's say, for example, again, Tesla goes up, right? Let's say you trim out of, in this situation over here, and then let me erase some stuff so it's less confusing. So for the 330 calls, let's say you trim one at 30%, you could hold that one runner for quite a while, even if there's drawdown on it, because it doesn't lose value as quickly. So you can actually hold, Tesla could go from, let's say, 325 to 328, and then retrace from 328 to 326. And in that little movement up and that little movement down, the value on the 330 calls will be there compared to 345 calls. Where if you were to hold the runners, even after you trimmed, right, those runners will lose value so much quicker, and that's gonna creep in the emotions of, oh my gosh, I gotta secure my profits on the exit. And then what's the point? You're not following your trade plan. You're not following what you think is gonna happen. You're just following what the options are showing you. You shouldn't let something tug you into making a decision. You should react based off your own plan and if it's validated or invalidated. And just because the options are not moving the way you want is a really shitty reason for you to exit a trade. It just is, right? How infuriating is it? Think about all the times you've exited a trade because the contract wasn't working the way you wanted it to. A lot of times the reason because of that is either two things. Either you're trading too far out of the money, actually three things. Or two, the IV is too high and you just bought at an unfortunate high IV environment time. Or number three, you're trading 0 DTEs and you're just getting thetaed. So you don't want your contracts being the reason why you can't hold runners. So remember, it's not always better to get cheaper cons, to have a bigger position in terms of quantity so you can trim out. Closing your full position is not always the best choice. Holding runners could help offset previous losses. And this is something that tied on to before. Basically what that means is, I always, I used to even think this as well, and I had to change my mindset about it. And I hear people say this even till this day, and it's just common. Everybody goes through it, where they're like, "Oh, I've been, I've been losing money, and let's say I lost $80 yesterday and 150 yesterday. I'm up $40 here. Let me just, $40 means a lot to me. Let me just fully close out of this position." Yeah, of course, $40 is a lot of money. To me, it doesn't matter what size my account is, $40 is still money. But that doesn't mean like you have to think about it. Why would you fully close out of a position? If the position and the trade is going your way, why would you not risk it? You have to think about it in this situation, right? This is just, I'm talking about my perspective. Why would you not risk it to work out to the full potential? And now, if you're just completely excuse me for my vulgarness here, but if you're a complete idiot and you're a retard and you're just like pulling out, trade plans from your butt and you expect it to work. That's not what I'm talking about. I'm talking about, you have levels on the chart, you're looking at previous price action, you're seeing momentum, you're seeing volume, and you're just, the only thing that's working against you is just your stupid mind, and it's just telling you, "Oh, let me take this profit right here." Sure, if you can trim, if it's really going to help you, go ahead and trim. That's up to you. Sometimes a lot of the biggest reasons that makes us to take profit quicker and sooner is a few reasons, but the main ones are either one, we're thinking about our previous losses too much, or two, we're over leveraged. So being over leveraged is not about today's live session. That's more about the risk management one we talked about. That's something you have to fix on your own, and you have to realize you're not a complete retard, and you shouldn't be, oversizing. But when it comes to thinking about previous losses, that's something that's really, I'm going to be honest with you, it's so much easier said than done, but it's something you have to do. Like if you know your plans are working out, if you know you can look at a chart and get at least an idea of what's going on, then thinking about previous losses is not going to help you. You're just going to hurt your confidence, and confidence is everything in trading. Remember, trading is not a get-rich-quick scheme, but it is very much a high-risk, high-reward environment. You cannot be sitting here trading passively and just, expect long-term results. If you have a bigger account, then you can afford that. But if you're trying to grow a small account, it's going to be very, very hard to grow an account if you're going to be passive every single way. I'm sorry, that's just the reality. Now, again, if you're like selling options and doing credit spreads, debit spreads, that's a different story. You have more things on your side, so you can be more passive with it. But when you're talking about buying calls, buying puts, you have to realize you're already not having an edge when you're buying options versus selling. So when you're buying options, you have to realize you're already taking an aggressive position. And if you're taking an aggressive position and making it a passive position, that just makes no sense. It's just not how things work. Just remember that. So when is it harder to hold runners? As we talked about before, it's always going to be harder to do it versus counter trend trades. So this kind of ties in, to when to hold runners. So when you're taking a trade that's counter to a trend, that that's, you have to realize that, and you that doesn't mean you completely take profit. A 10% profit. That doesn't mean that, but that means if you're going to, stuff we'll talk about deeper into. But if you're getting into a scalp that's like puts against a bullish trend, yeah, you could hold runners, but make sure to keep that stop somewhere close, right? At least have a stop, because trends are strong. Trends are not, friendly and slow and the old grandpa. No, you usually get ripped in the face, especially in puts. How many times do you get a put set up on a bullish day? That put goes like 20%. You try to take profit. You take profit on some of it. You hold some runners, and out of nowhere, especially if you're in zero DTs, it just bounces, and half of those profits are gone, if not more. So if you are in a scalp, realize that it's going to be way harder to hold a runner, and you might want to set stops or not even hold runners to begin with. Zero DTs. Now, zero DTs is going to be basically, I would say, the most intricate and the most special part we'll be talking about, especially on Thursday. Because, for example, sorry, my headphones just fell out of my ears. For example, if you guys have been a observing the past 2 Fridays, that's when I primarily do zero DTEs, right? I like trading Tesla and Meta on Fridays. So there's Tesla Friday and Meta Friday. And the past 2 Fridays have been freaking phenomenal when it's come to Tesla and Meta, but primarily Tesla. And you're seeing me trim and hold positions to like 1,000% profit. That doesn't mean I'm holding my full position there, or even majority, or even a decent amount. I could literally be holding, there's been times where I'm holding just 2 contracts or even 1 contract to that point. That's not going to be replicatable by everybody else. Nobody has, again, this is just me being blunt. Nobody has the account I have. Nobody has the experience I've had. Nobody has the complete greed that I have. I'm at this point, I have enough profits where I can be greedy. But when you have a small account, you need to have the good mix of having greed and also having logic. So when it comes to zero DTEs, it's already going to be harder because runners can easily lose value due to theta. If runners are held, they should be held in small quantity. So again, another example, let's say you get into SPX calls, right? And, SPX calls reach 30% and it hits one of the areas you want to trim, go ahead, trim. Why out of the 10 contracts, hypothetically, why don't you take 7 or 8 or even 6? Just take 6, right? You take 6 off, then, it goes to 40%, and then out of the 4 remaining, you take 2 or 3 more off. There you go. You have 1 contract left. Why not? See where it goes. See where it goes if you see the trend continuing. You don't just hold it and hope something happens. Because how many times does that happen? It doesn't happen that many times. Yes, of course, in this market where, the passion mango fruit Trump can say anything any single second, right? You do have volatility, but it's like after 4 hours of theta decay. So if you're seeing something continuing your way, then you could hold runners on zero DTEs. And sometimes it is so profitable to hold runners on zero DTEs. But that does not mean you hold your majority of your position. Which then therefore means if you want to hold runners on zero DTEs, you primarily would want to do that on trend continuation trades. So very simple, because some people will, if I'm over explaining, the reason I over explain is because I get questions to answers I already gave. But if you're buying SPX calls on a pullback like this, right? Let's say you enter right over here, and let's say you wanted to take majority of profit at the previous high. Once it reaches over here and you bought 10 contracts over here, go even trim out 9 contracts. That's a zero DTE trade. You already don't have time on your side. This much profit is already beneficial to you. Go ahead and take it. But if you're already seeing, prior to this, there was consolidation, it was bullish and stuff like that, and you have a price target up here, let's just say at, 5,000, I don't know why I put 15,000, 5,950, because we're talking about SPX, right? Or sorry, not 5,000, 6,000. Why not hold it? If it's not going to severely hurt and dent your profits, and you genuinely see a trend continuing, why don't you put a little more confidence in the trade and just see it run? Now, that doesn't mean you have to keep it naked. And again, this will tie into what we talk about on Thursday. You could set stops, trailing stops. There's so many things you could do. But if you're doing zero DTEs are basically, this is the best way to put it. Holding runners can be the most profitable on swing trades. And the second most profitable way you could hold runners is on zero DTEs. But it's the least probable trade you can hold runners on. So again, it ties back into the high risk or high reward. Swing trades, if you catch the trend, if you just hold it, and you have a solid plan, you're easily, sometimes if you have a good plan, you're going to have high profits. That's, it's not really a sweating thing, right? The only reason why I've not swung recently is because it's not a swing market. Slowly it's creeping back into a swing market, but it hasn't been the past 2 months. But if it's back in a normal market, best believe I'll hold my calls decently fine. If you guys remember, I got the NVO calls. Those went 800%. We got those call swings a month ago, less than a month ago, 3 weeks ago, I think. Those are up massive, right? It's easy to hold runners on swings. But the reason why it's also very profitable to hold runners on zero DTEs, if you're in the right trend, emphasis on that, is because the gamma exposure is very high. And what I mean by that is there's so much to this, and we're going to talk about this one live session. But there's a thing called intrinsic value, and I'm going to keep it completely simple and dumb. And you should do more research about this if you don't want to wait. But a call in the money needs to have a certain value. But the calls out of the money will expire worthless. Which means the closer the call gets to being in the money, or the put gets to being in the money, it needs to reach a certain value. So the value of the contracts increases exponentially, right? Like at a very fast rate. So because of that, you can literally have, let me find a place to draw this. You can literally have, a range day, you get into calls, let's say you get into calls right over here, and you trim right over here, let's say because of theta, and it just, you trimmed 10, you bought 10 contracts here, you trimmed 7 here, right? And you get a move up here, but theta's are getting, contracts are getting theta, so you remove 2 more, but you still believe in the bullish trend because it's just consolidating. Let's say you got the $6,000 calls on SPX. Yes, during this time, you're going to imagine your contract value to look something like this, right? Oops. Right? But the second it goes from being consolidating to breaking out, and it gets closer to the strike that you bought the contract for, and you've seen these on SPX cons especially, versus QQQ or SPY, your contracts will literally balloon like this. And that's why a lot of times, the best times to trade SPX is actually in the afternoon. Because you're putting up very less capital, but your gamma exposure is very high. And if you get the move you want, your calls value increases. You've seen so many times where I've seen so many times, and I've traded these, 50-cent contracts go to $8, right? Because of the gamma exposure. So again, zero DTEs, you can hold runners, but you need to think, okay, am I trading with the trend? Am I still seeing what I want? And if I have already secured profits beforehand, I can potentially risk it. Now again, risk management, all this stuff, if you can risk it or not, ties back to your own personal situation, whether that trading money you have there is something you can risk or not. I can't, baby feed that to you. But those are things you need to think to yourself. A lot of people don't think about these things. That's why I'm here. High IV environments. Runners can lose value due to violent moves each way, which causes an IV crush. What that means is, we've talked about IV before, it is probably the most important thing you could learn as an options trader. And if you don't know about it, you should watch our previous videos, or I'll just have another live session about it one day. If you buy at a high IV environment, your contracts are already inflated, right? Because the contracts are pricing for a very volatile or, a steep move to the upside or to the downside. But if the stock is not moving that much, obviously the IV is going to be lower because the contracts are not pricing for a sudden move or a very sharp move to the upside or to the downside. So if you're buying in the high IV environment, and the underlying stock or the ETF that you trade is moving in a very consolidating manner, or it's just chopping, you will lose a significant amount of value, which means that it's already going to be harder for you and less logical for you to hold runners, because then you're just going to be exposed to theta decay, and it makes no sense. And the funny thing is, you might be thinking, isn't this similar to zero DTEs? But it's not. This actually pertains more to swings and day trades and not actual zero DTE day trades. Because yes, zero DTEs do face IV and high IV and low IV. They definitely do. But ones that are most impacted are swing trades and day trades. Because the initial value of the contract, like if you're buying a contract on Tuesday for a weekly contract as a day trade, if the IV is high, the contracts are going to be very expensive. compared to if you bought a 0 DTE with high IV, because the contract has already lost so much value because it's going to expire that day. So it's not like the IV, yes, it will have an impact, but it won't have as much an impact compared to a contract that is a weekly or a swing trade that's, a month out. So do realize if you're already putting yourself in a place where you're in a high IV environment, then you might want to be a little bit considerate about your runners, and you might not want to hold runners in the first place. And you guys could keep on asking your questions. I'll get to them afterwards. I just don't want to lose my train of thought. Decreasing volume. We've talked about volume before. We have a live session about volume. Volume decreasing can hint that there's less chance for a continuation of the trend. This can be seen on the 5-minute, 15, 30-minute, 1 hour, whatever you use. I've talked about my personal preferences on volume. But just so I can demonstrate it for you, let's say you have calls. You bought them same over here. Let's say you bought 10 contracts, right? Say you bought 10. And, right? Let's say you trim 6 here. Let's say you trimmed an additional 2 here, right? But on the bottom, let's say this is just volume. I'm going to make it as a wave, right? Let's say the volume is increasing, and then all of a sudden it's decreasing, and it's decreasing. Decreasing volume in a trend is not a good thing. That basically means there's less market participants in the trend that is going. And the way to make that very simple is, let's say a stock like CoreWeave, everyone wanted to buy, right? So obviously, even if the price is at $60, people will still keep buying it. It goes to $80, people are still buying it because they think it's going to go to 150. And it reaches 125, people are still buying it, so the volume is still high. But the second it reaches $150, obviously people are thinking, oh, this is the place I wanted to go to. I'm not going to buy more shares here. So less people buy it. Which means then, of course, if less people are buying it, there's less possibility for it to keep on going up. Because then, eventually, if people want to start taking profits, then the stock goes up. So that's how you correlate volume with runners. And if you're seeing decreasing volume, after these 2 trims, you're only left with 2 contracts. So maybe you're thinking, okay, you know what? Let me trim 1 more here. Right? Let me trim 1 more here. And let me just put a stop, at break even, above break even. Again, this part we'll talk more on Thursday, but you could just set your stop somewhere and just let the trade run. If it runs, if it doesn't, if it hits your stop, it's fine, whatever. Right? These are just hypothetical scenarios. But this is how you look at volume, right? This is just a very simple version of looking at volume. And the last thing we're going to talk about today is news-oriented markets, and this ties into more today. News brings unpredicted volatility and higher risk for runners. That is something that especially is happening these past days. And obviously with the whole Israel and Iran conflict, the market is exposed to a lot of overnight moves, and you could have a very valid setup for a swing, and it's just, you could be up and then all of a sudden you're down the next day because of some news that comes out. So basically, this pertains more to swing trades. But majority of the times, because there's 252 trading days in a year, out of 252 trading days, maximum 60 fall in that criteria. So that leaves you with 192 days where this is not something that relates to your trades, whether it's a day trade or a swing trade. But you need to be smart enough to realize which kind of market you're in. Because now when you're in this kind of market, if you actually talked about before this whole Israel and Iran conflict, it was a risk-on environment. The way you could see risk-on environments, very simple. Again, this is off topic, but the way you could see that is by looking at small cap stocks or IPOs or theme stocks. What do I mean by theme stocks? Nuclear, right? You guys have all heard of Oklo and SMR. So if you see those stocks primarily doing well, if you see robotic stocks doing well, if you're seeing IWM doing well, if you're seeing HYG, which is the corporate bond ETF, something like that. If you're seeing those doing well, that's a risk-on environment, which means there's going to be more possible upside. There's less news, right? But the second you get into this news environment, which we're in right now, right? Before it was the tariff thing, right? Now it's Iran and Israel. You're going to have less possibility to hold your trades. Today was a very difficult day to hold runners. That is why I trimmed out of most of my CrowdStrike calls that went 135%. In a regular market, I actually would have had a majority of my position till 60% because I saw where that setup was going. But I also saw the things that would affect the trade, such as, let's say, Trump deciding he's going to wage war against Iran and join the war against Iran. That was actually going to happen possibly during the market hours. That could have killed the trade. So I actually, instead of taking what I usually do, which is, I usually take profit around 40, 30%, I actually took most of my profit around 20% because I realized we're in a news-oriented market for that trade, even though it was a day trade, and I didn't want to risk it. And that trade ended up going 130%. I'll be honest with you, I will not tell you my original sizing. It was a decent amount, but I will tell you for the 130% trim that I got, I was only holding 3 contracts. So I trimmed one of those 3 contracts, and I have just 2 left. And for reference, 2 for me, for that CrowdStrike trade, is a very small position to what I usually hold. If this was a risk-on environment and it was not a news environment, I would probably have around 10 or 8, just knowing me. So basically, this is how to know when to hold runners, right? Again, we're talking about this, and we're going to be talking about part 2, which is going to be how to hold runners. I was going to talk about certain things such as IV, what kind of IV ranks and IV environments we want to be in, and how to hold runners. When we're going to talk about stop losses or static stop losses, trailing stop losses, possible indicators you can use to help you with momentum, whether it's volume or something else, moving averages, whatever. But it's very important that you guys understand this part before we move on to the next part, because if you don't understand this part, the boring stuff, the things that will actually help you, which is the how to hold a runner's part, is completely irrelevant. So this is what I had to talk about today, and the session should be on Thursday. I'm sorry, but I can't promise for Thursday. This is me being completely honest. I'm emotionally and mentally exhausted, and it's very hard for me to do live sessions to the amount that I want to, but I will be able to soon. So whenever I do have a day where I'm not completely mentally exhausted, and yes, part of the mental exhaustion comes from being in this market where we range 6 out of the 8 hours in the day, and the moves that you want to catch is the moves that happens in fractions of seconds or minutes, and that's it. It's kind of tiring to look at that, and it's my job to look at that all day, so it's a little bit taxing, and then of course I have a life other else, so it's a little bit tiring. So I do want to aim for Thursday, but I'll I'll keep you guys updated. But you could go ahead, type out questions you want. I'll briefly answer them, even if they relate to how to hold runners. But if you have questions regarding what I talked about, I'm more than be happy to answer them. And we could go and continue onwards with the next session. You guys can type it. It would be best if you could type in the live session chat. It could literally be anything, as long as it's not too personal, and I'll do my best to answer it. Do you ever live trade? No, I don't live trade on live sessions. Reason I do that, pretty straight up. You guys are obviously coming from different servers. The server owners wouldn't like it if I start live trading on here. Why would they? Right? Then it just seems like I'm opening up a paid server here, so I can't do that in respect to them because they allowed these posts to go out to their servers.
But sometimes I'm live on video.
Let's see. Don't listen to this guy. Take out a
Yes,
mortgage.
nobody cared about that. Nobody even cared that sometimes I live stream. Okay, myself. Okay, great.
Yeah. Don't listen to this guy. Take out a mortgage and put it all on red. Yeah, absolutely. Sure. Just kidding. Oh, okay. All right. That's funny. Gotta have a good ratio. 7 losses at 1 hour can be overcome by 3 ones at 3 hour. Only 30% win rate. Yeah, hard to come that was only contrary. Yep. Twitch secrets continue contributing to it. Absolutely. I agree with this. I think you were trying to put into words probability versus profitability. Out of money might be more profitable, but eight. Yep, exactly. Yeah, you put it into a nerdy version, but that nerdy version is great. Thank you. When you're not confident, you take profits. So yes, this ties into, for example, the part where I was talking about, you know, the where was it? The volume part, right? Volume is a huge indication on the confidence of the actual sentiment, right? I don't mean this in any snarky way when I say this, but the market doesn't care about what you think and what you're comfortable about and what you're feeling, right? The market is a collective group. So it's a collective sentiment. So if the stock is still bullish and you're in calls, yeah, of course, if you're uncomfortable, right? If you're not confident, I completely understand that. You have to stick to your plan. Absolutely. But if the market is showing you something else, and the plan that you had originally has not executed fully to its potential, one thing you might want to consider, emphasis on consider, is looking at the technicals, seeing if there is still volume, if there is still a sentiment push towards your way. And then you might want to consider, okay, is my lack of confidence, is it reasonable or unreasonable? If it is reasonable, by all means, go ahead. That is you protecting what you're doing. Absolutely. But if you have to be blunt with yourself. You can't be lenient. You're blunt. If you're not confident just because you're shaky, you have to then decide, okay, do I want to risk it or not? And it's not a soft game. You have to realize if you hold runners, you have to be okay with losing the profits that you're risking. That's just the reality. There's been so many times where I could take full profit at 20%. My win rate would literally be at like 98%. But it's not. It's down at 91. Because sometimes I trim at 10%, but I still see a further move, and let's just say it doesn't work out. Let's say I miss something, or news comes out, or volume just dies off, whatever it is. I am okay with risking that profit that I ended up giving away, because there's been so many times where the trade still ended up working my way, and me risking holding those runners worked in my favor very well. But again, my situation's different than yours. I'm just telling you the way I think about it and what's worked for me. How do you know when IV is high or low compared to what it's usually at? Very good question, but I've actually answered this in a video before. I'll pull this up for you. So if you guys are here new to live sessions, we do have a YouTube channel. Let's see. Can't bear to hear my voice. So if you go to our YouTube channel, it's Taylor Trades, right? You search. I put this link. You'll find it in the server. If you go to links, you'll find it right here, our YouTube channel. If you go to this YouTube channel, we have already our previous live sessions recorded, and there's still a lot more that I still have to publish. The recent ones are how I draw levels and trend lines, and then how to day trade with unusual whales. If you scroll down, this is the thing you want to look at. How to pick options by looking at implied volatility, IV. This one directly and indirectly answers the question that you have, which is when to know when the IV. What was your question? When the IV is high, right? Yeah, when the IV is high. So IV rank is one thing, and IV percentile is the next. So there's two things you could look at, and depending on the broker you use, it would show it or it won't use it. Thinkorswim I've always highly advocated for, shows the important data regarding that. If you use Tasty Trade, that shows IV rank and IV percentile. So yeah, so watch that video. Just trying to see if I posted anything related to, yeah, so it's just that video. All right. Do you have previous sessions? Yes. So if this is your first one, again, I'll just for ease, I'll put the link of the channel on the whoops, bro, on the live sessions chat, and then you can find it there. If you for some reason are lunatic enough to hear my monotone voice for an hour, how much are these? Yeah, hour 30 minutes. Props to you, but I can promise you I put literally 4 to 6 hours each time before I came up with each and every single live session I did. So you can definitely believe that everything I talk about here is not only done from my experience, but one thing that's different about the live sessions you'll find is I not only take what I've done and what I've seen works, but I also research about things I don't know. So, that's the positive to it. So not only am I learning, if I am learning, my whole perspective is I can know 99 things in a book, but that one thing I didn't know in that book can literally be beneficial to me. So I bring that same perspective to live sessions. I put hours back testing or looking at charts, just making sure what I'm talking about is going to be right. And then I also go and research, read books, and I read research articles, look at statistics, all that stuff on Thinkorswim, all these platforms. And so I don't know why I'm going on that. Yeah. Let's see. Is that a website? No, it's not a website, bro. You know what? I bet a lot of you guys weren't here for the Ivy thing. I'll do a live sessions on Ivy because that's a very important thing to talk about. Let me see here. It'll be listed next to, yeah. So Toshanks, the thing is, for example, I believe a lot of people here use Robinhood. Unfortunately, don't know why, but you guys do. I get it. It's easy to use. It's a shitty platform though. That's just me being blunt. Robinhood doesn't show either of those statistics. It doesn't show Ivy rank or Ivy percentile. I've always said this. I literally have a video on Twitter, and I'm gonna upload it actually this week on how I use Thinkorswim. You can open up a Thinkorswim account for free, and all you need to do is just deposit $50 into it, and you get live data. That's it. And anytime you want, after the funds settle, you can literally withdraw the $50 just for some reason if you needed it. So you can literally go open up, and I'm not sponsored by them, unfortunately, because I've given them so many sales. You can go ahead, open up a Thinkorswim account, and it will show you, for example, the Ivy rank on Thinkorswim. You can also do the same thing for Tastytrade. Tastytrade easily shows you both Ivy rank and Ivy percentile. So feel free to do that. Either of those platforms are great. But I do have a video on Thinkorswim, so I'll post that video this week or next week. Do I believe in ICT? Absolutely not. ICT is absolute crap. I'll stand by that. Don't care. That's why a lot of ICT traders don't last more than a year and a half, if they even reach that mark. The reason why I hate it so much is because it's either counter trend trading, it's completely autistic, and it just only feeds into your, I want to be safe kind of thing. Trading, again, does not care about your feelings. It does not give a crap, right? Just like I will care about my money, you will care about your own money. So ICT, the thing I hate about it is it gives all these little fancy terms and makes you think that you're a genius. And then when you do actually something retarded, but you're following something that has genius words and it ends up going against you, then it's like, they're after me, they didn't work out because of this and stuff like that. It's not how the market works. It's just not. And what upsets me even more is it takes some parts of like really important price action and it dumbs it down so much that you miss the other parts. And it's why also that leads me to, why do you think I've not done a price action live session so far? I've already I've already stopped doing my one-on-ones. Not because I don't have the time to do it. I definitely have the time to do it. It's not so it's not like I'm gatekeeping, but it's because if I teach you how to do price action, or I teach you everything I know about price action, there's still so many other things you don't know that if I just tell you about how I trade price action, you're gonna find a mud pile that you're gonna unfortunately put your foot into, and then you don't know how to get out of it. And that mud pile might be pretty deep because you think that you know price action because you watched the Bishop, live session on it, but then you're screwed because you don't know the other things that ties into how price action works. So that's why I don't believe in ICT. No, I think you can easily read a book. I could literally, you know what? I'll literally post a bunch of books you guys can read, and I can promise you, your own observations and reading those books would be a lot more beneficial than following that crap. It really is. Like simply just putting levels on a chart, and again, you could watch the video over here where I talk about am I streaming my screen? I'm streaming my screen, right? Wait, let me see. So yeah, all right. So literally like YouTube channel, you could watch this video, how I draw video levels and trend lines. And if you want to go according to that, draw your trend lines according to that, or just do a little bit differently and just know the simple concepts of buying at support, selling at resistance, and then obviously adding more intricate things to that. I found people keeping it that simple have done more successful than people who trade ICT. My opinions, of course. How long have I been trading? I've been trading for 12 years. I'm 24 now. I started trading when I was 12. As crazy as that sounds every single time I say it. What do you mean you can afford to be greedy? Simple way. A person who has a $5,000 portfolio can be more greedier than a person who has a $1,000 portfolio. A person who has a $100,000 portfolio can be more greedier than a person who has $5,000. Basically, what I mean by that is the more capital you have, the more cushion you have to be stupid and allow mistakes. Versus the smaller capital you have in your account, the less room you have for errors because it makes much more impacts against what you're doing. That's why. So I can afford to be more greedier than most people. That's why I'm saying, all the trades. For example, like CrowdStrike, I know a lot of people got into that today because it was a very easy trade to enter. No one, I honestly didn't expect anybody to hold it past 50 or 60%. I'll be honest with you. The 130% I had is because I can afford to be greedy. Most people cannot. So just make sure you remember that, is what I was trying to say. How do we keep runners if we have set stop losses? For example, on Webull, once a trade is executed, I would set a stop loss, but that stop loss wouldn't let me close just one con to leave runners. Well, that's just a platform issue. I can't. That's why I said that Webull is not great. You guys love getting me into rants. Let me tell you something. All right. Listen, Linda. Listen. I don't know why I'm saying that meme. That meme is so old. I'm gonna rank to you from worst, in my opinion, worst to best platforms. I'm not gonna cover all of them. And the reason why they're ranked this way is because of a few factors. One, it's either because of fill times. Two, it's deceiving practices, such as saying that, oh, we don't charge you with commission, we're free, or we have low fees. That's not true. Don't ever fall for that. I can't spell practices. Geez, this is why I still have 150 hours left in my internship. Number three, they lack tools that are important. And number four, they have option rebates, because I don't know what the fudge that is. Apparently I've been seeing that platforms are offering now option rebates. Bro, that's the most sketchiest thing I've ever heard. What platform will give you money for... Never mind, I'm not going to even... So number one, you guys all know what I'm going to say. Robinhood. Bro, this thing dookie. Are not to spell dookie, but we'll just say it like that. Number two, because this literally falls under three of these categories. That is why it sucks. Number two is a tie between Moomoo and Webull, right? Everyone thinks that Webull's great, and if it's working for you, that's absolutely fine. But one thing that sucks is I think they're heading into the option rebates thing, which I don't understand and is concerning to me. But the thing that Webull sucks about Webull is actually it lags a lot of tools that a platform like that should have. It lacks tools and it has a little bit of deceiving practices, and the fill times are not the greatest. So that's why Webull is number 2. Now, after this, I'll be honest with you, the following platforms are actually not bad. There's a huge gap between these two. And I don't know why the arrows are that ugly, but like number 3 would be Interactive Brokers, so IBKR, right? That's a good platform. Fidelity is a good platform. What else? Yeah, Fidelity is good. And then number 4, I would put like E-Trade. E-Trade, Tasty Trades, right? E-Trade is more fundamental trading, scalping, news-oriented, old-timer kind of thing. Tasty Trades is more option selling, swing trades. And of course, number 5, which is the best and most, again, without bias, is Thinkorswim. Because again, as I've talked about, the fill time is superior. Yes, the commissions are high, but nothing good is cheap, right? So you do have high commissions, but you have amazing tools, the best fill times out of all the platforms you could ever get. And yeah, I mean, what more do you need? So there's my 2 cents on platforms. So that is a platform issue. Can't do anything about that. I'm the nerdy version. Yeah, bro. I'm Indian. I'm supposed to be a nerd, but I'm not. It's weird. Or maybe I am, and I just refuse to accept it. So we trim based on if we can already in a profit, even if our contracts go to 0 and there is a clear uptrend, right? Also, when there isn't used at. All right, some guy. That's like some English and that's some sentence. All right. I'm so sorry. That's a joke. But and it sucked. But what I'm trying to understand what you're saying. So yes, if you're already in profit, obviously that's when you trim. The only other time you would trim is if you're trying to de-risk, if you're not already confident in the trade. And if you're already not confident in the trade, then there's less probability you're going to hold runners. So that's not even part of this. So if you're obviously in a trend, that's going to give you probability to hold your runners. So yes. And obviously, no, when there is news, that's when it does screw you over. Sometimes. When there isn't news, that's when the sentiment usually continues. You know, yes, there was, for example, let's say a few weeks ago before the Iran and Israel situation, yes, you could have said the tariff situation was there and that was news. But also, the truth was, the market also didn't give a crap about what Trump was saying regarding tariffs. So the news wasn't really important. So even data came out, didn't matter. Market went up, right? Trump said something about China, doesn't matter. Market went up. So when news isn't there, that's when it actually benefits you. You have that sweet pillow talk tone to your voice. I really like a boring textbook. Well, I'll take that as a compliment. Sorry, a bit off topic, but why is FOMC important? That's a JP question. But basically that talks about interest rates. And interest rates basically talks about borrowing and increase in borrowing versus less borrowing. And obviously, if a company borrows more money, that means they can innovate more or they can invest more into what they're building. And if they're obviously, and they'll do that when the interest rates are lower, right? So obviously, if they're investing more, that means they have more potential to be profitable, right? This is the dumb version. They have more potential to be profitable, which means there's more business, which means there's more money out there, which means people spend more, economy goes up. Versus if the interest rates are higher, the reason why it would be higher is to decrease inflation, which means that inflation is caused by people buying too many things, too much money being out there, and there's less supply, right? That's what happened during COVID. The stimulus checks went out, and money either went to buy stupid things or went into the market. So because of that, let's say you think you have a bike store, and a bike store has 5 bikes, and he gets 1 bike per day. If people get stimulus checks and people go to a bike store and 4 bikes get bought off the shelf day 1, day 2 he only has 2 bikes. And if 4 people come in You know, only 2 people get bikes, and there's still 2 people remaining, and he only gets 1 bike tomorrow. But then tomorrow comes, that one of the 2 people buys that bike, but then 4 more people come, and there's now 5 people waiting for a bike. Obviously, the guy who's in the shop realizes that his supply of bikes are very valuable because he has a lot of buyers. So what happens then? The price of the bike goes up. He raises the price. And then eventually people realize, hey, that's too expensive. I don't want to buy that. So then they don't buy the bikes, which means less profits. Which means now if the bike store wants to go take out a loan to build a new store across the street, he realizes the interest rates are too high. Doesn't make much sense for him, so he's not going to do that. He doesn't take any loan. There's now not a new bike store across the street. Less people are buying his bikes. He starts now having an increased supply in bikes. And that's how the cycle repeats. When to exit runners, that'll be talked about in our next live session. When did you start to hold runners? After how many years of experience? Since day one. Well, let me rephrase that. I stupidly held runners day one. I logically started holding runners after, I would say, 3 months. That's when I started to think about things. Because if you guys remember a story, 3 months in, I took $300 to a very substantial amount. And again, I started trading with $300, and I'm here now. And 3 months into my first 3 months, I took $300 to a very substantial amount, and I lost 80% of it because I was too greedy with my runners. And that's when I learned my lesson. So yeah, after 3 months. According to how I get through college, monotone don't bother me. Well, thank you. Thank you so much for training. It's what I'm here for. I believe it's my purpose. It should be everybody's purpose to give back, especially when you have the privilege to learn so much. One thing I can say is I had the privilege of not growing up with a mentor. I learned everything I learn now without using anybody's help. And one thing that did do for me is it benefited me because I didn't have bias in my teachings. So I read books, I read things, I observed, I came with my own bias, and it gives me a lot more confidence and a lot more leeway in researching things because I'm not stubborn about a single way of trading. So that's why I think live sessions is great, because, I genuinely want live sessions to be a place where you guys can learn. Anyway, I was going to go into a cheesy route. Well, I can't comment on Robinhood without insulting people who use them. Oh, dude, I know. You're a kind guy. I'm not kind. I'm a douche. I will outright insult Robinhood, even if people use it. Yeah, if you're serious enough in trading to be joined the least live, yeah, absolutely, I agree with that. What do you think about breakout wedges and continuation plays? Continuation plays are great. Chasing breakouts are not good. I don't think they're good. I think, for example, and this is not the live session today, so I'm not going to go deep into this because we've been running for an hour and 13 minutes. So, oops, how do I? Let me connect to my amazing Samsung tablets. By the way, these Samsung S9 Ultra, that's the one I have. S9 Ultra, S8 Ultra, S10 Ultra. I used to love the iPad. That was the only Apple product I ever loved. Not anymore. These freaking tablets are amazing. I mean, I'm sorry if anyone's an Apple user out there. Bro, your Apple products are just not innovating. They're just not great anymore. These Samsung tablets are amazing. But anyway, I digress. For example, a common play that everyone tries to play is the wedge, right? Usually people play it to the upside. A lot of people try entering here for the breakout to the upside, but how much potential is there really, right? I wouldn't like entering around over here. I would like entering around here, because here's the reason why. What happens is sometimes when you get a breakout, you either have a retest of the trend line. So your probability for increasing is already low because you have most likely a retest. So that means the profits you take here is not going to be significant. So now you're running through, whether it's a day trade or a swing trade, you're running through this time period of theta decay. Versus over here, and it's also harder at this point to figure out where your invalidation point is. Because how many times have you bought it at this point over here and you're like, oh, if it comes over here, maybe I'll cut. If it comes over here, no. It's just like it's harder to figure out your invalidation point. It's very important to know where your invalidation point is. Which makes this, oh my god, my English, please. Which makes this entry point over here down at the bottom trend line, for example, for me, is a better entry point, because if this breaks through, okay, or I know, all right, I don't want to hold this anymore because now it's broke the trend line. Even if it goes up, it's fine. I already know that was an invalidation point, whatever it is, right? So you have the probability of it going up, and you would theoretically easily know when your trade gets invalidated. So that's a very simple way on how I do that regarding breakouts. But again, we'll have a live session on that. Again, live sessions, I posted this announcement for a reason, you know? Man, I really pushed a live session on this for a long time, didn't I? I did say I would be no longer offering paid one-on-ones, and I legitimately will tell you everything I know over here on live sessions for free. I genuinely mean that. And again, you could watch our YouTube as well. I'll be blunt with you. What do I get out of this? I have a very odd satisfaction with numbers. All right. That's what got me into start trading. And I know this reason is gonna sound so dumb, but man, do I love seeing those YouTube numbers go up, man. Oh, it's so satisfying. It's just like option percentages. Why do you think I switched from penny stock trading to option trading? It's so satisfying looking at percentages. So if I see like why am I talking about this? Anyway, if I see like a 25% increase in viewership, I'm like, oh my god, that's so cool. I don't know how my wife is still with me. All right, let's see. What else? Had you start trading at 12? I have kids who I can. So actually, hold on. Let me bring this. So this is very good because there's this video and I'll post it. So I actually got on a podcast over the weekend with this guy. He has a very small YouTube channel. You guys should support him. Really great content. It's called Stonkcast, and I'll put this there. He actually interviewed me, and I actually talked about a lot of things, which are actually quite important and pretty cool. I thought are cool. You obviously don't have to, agree with that. But check out that thing. It actually goes over. I don't know why I didn't post. Why can't I? Okay, there. I'll put it in main chat. Go to that link. Check it out. It's actually a little bit. I don't talk too deeply about my story, but I talked a little bit about it. But support that guy's channel, by the way. Really good guy. Good content too. Tell him that Bishop sent you. But the way I started was, I have a stupid story. I'm Indian. My parents were very hardworking, so their hard work kind of rubbed off on me. I had a weird obsession with numbers, meaning I was the type of guy who likes making money, but I never spend it. And that sounds very Indian of me, but I'm not stingy, I promise you. But I I used to like grow these Instagram accounts, and I don't know if you guys know football, but football is a game called Madden, right? And there used to be a game on the phone called Madden Mobile. So you could sell like in-game currencies, which is basically just money to buy players, for people who don't know that. So I basically sold the in-game currencies. I grew Instagram accounts. I sold that. And obviously, I was much younger then. So at that time, I was like, oh my God, I'm making money. But then I realized like the life I had caused me a little bit to grow up a little bit quicker. So I realized that I want to be doing things that would create longer lasting wealth, or at least give me side income. And I started researching more about markets and stuff like that. At that time, YouTube was not very diverse when it comes to trading education, because a lot of it was buy my course, hey, buy this penny stock, hey, new pharmaceutical stock is coming out, so it was all penny stocks oriented. So I couldn't use YouTube. So what I used was, instead, I used books, and I read books, and they were a blessing. I think books are still one of the greatest ways you can learn. A few of the guys here, keep on asking me for books. I keep on sending them books. They love it. They read it. They learn so much from it. But then it's not just learning, it's observing. And that is, thank God for this. God gave me this attribute. He gave me the ability to observe. And what I mean by that is I would look at the chart and I tried to make sense by the education I used to figure out what's going on in the chart, and that helped me understand things a lot better because I'm a very stupid guy. So I needed to dumb things down and make things simple. So I did that. And that made me understand very complex subjects. That's why I know a lot at such a very young age. It's not, of course there's multiple hours, countless hours that I put into this, and years, but it's very much due to reading and observation. Nothing can beat observation. You can even literally watch all my live sessions, which I highly advocate for. It's not going to turn you into a millionaire or thousandaire, whatever, but it will mean nothing if you don't tie in your current observations that you genuinely see onto the chart to versus what I'm talking about here on live sessions. And once you do that, it's like seriously mind-blowing. You're like, oh, wait, this makes sense. Or, oh, wait, maybe. The thing that's great about observations is you get questions. And when you get questions, you can lead yourself the way to finding answers that you didn't even know you needed. For example, you realize there's an overnight move that you don't understand what happened. Oh, what happened with this? Why is the market down? Oh, there's something about, Japan dumping treasuries or bonds. What are bonds? Oh, these are bonds. Why are bonds important? Oh, wait, these are why bonds are important. Oh, wait, hold on. The bond market is 12 times larger than the US equity market. That's now you learned all about that. Right now you know how the bond market yeah. So you'd recommend Thinkorswim? Yes, I do. That's what I personally use. I used Thinkorswim, Robinhood, and I've used almost all platforms. I've used E-Trade, Interactive Broker. I've not used Interactive Brokers, but I've heard great things. Fidelity. I've used Webull. I've used Robinhood. I've not used Moomoo, but I've nothing against Chinese products, but bro, that app I just don't understand. They have Moomoo merch. It's funny. I've nothing against them, but I just the fill times are just not that great. Teaching that voice, please. Oh yeah, sure. It's more common than you think. There's a few high schoolers now who are traders, and yeah, I mean, there's more younger traders now. Makes me feel less special. Boo hoo. Who cares? But I mean, that's the thing. Now anybody can start it. It was much harder to start trading when I traded because everything was just paywall, or you had to go buy a book, and books were already so expensive. Books were very expensive back then when it came to trading. Thank Amazon, by the way. If it was not for Amazon, books would still be very expensive. But anyway, I digress again. You now can search up a lot of things on YouTube, but here's the thing. Here's a caveat. You need to understand this, and I'm going to wrap this up soon. There's a lot of misinformation. That's why live sessions is a thing. If I personally believe the content out there was really informational and really informative and not misleading, live sessions would not be a thing. The whole reason I have a YouTube channel is because there's so much misinformation out there. You know what I hate the most? And this is why my YouTube, bro, my videos can be, I kid you not, I have editing skills. I can make my videos freaking 15-minute, 10 minutes long easily. But what people don't understand, and this is why I don't like the other YouTube videos out there, it does not take into account the other different situations that people are in. And it does not consider the fact that people perceive data, numbers, and emotions in different ways. Which is why our live sessions is so expanded, each and single video, because you need to talk about everything. Because when you talk about everything, that's why books are beautiful, right? Books are not just like, 15-minute read. No, books that are informative are like 300 pages, 200 pages, how many pages, because it talks about everything. That's what videos should be like. The long videos that don't have misinformation are some of the times the greatest thing. So you have YouTube. If you're going to ask me, how do I figure out if there's misinformation or not misinformation? I can't tell you. Maybe from here and there you can ask me, what do you think of this YouTube channel? Maybe I have an opinion, maybe I won't. But that's something you have to figure out, unfortunately. But again, I mean, there's so much content on live sessions that, you probably don't even know about. You could read up on that, and then there's plenty of other good YouTube channels out there. You just have to try really hard to find it. If we are poor, use Robinhood. No, I don't think you can. I've seen people, again, I started Thinkorswim. I started Thinkorswim with the $300. when Thinkorswim commissions were extravagantly high. So no, using just because you'd have less funds does not mean you just completely go to Robinhood. That's just no. No. If you're hell bent on avoiding commissions, then I understand that, but then you have to realize that maybe the trades you're taking are not good in terms of quote unquote risk to reward, whatever other term. I don't know why I hate using that, maybe because ICT traders use it and it ekes me, even though it's a valid thing to look at. If we reach no. Well, some guy putting out some thoughts, huh? Yes, by the way, I agree with this. For IBKR, it's really powerful. Yeah, dude, I've heard good things about Interactive Brokers. I have not used it, but one thing that is a really huge benefit is I know that platform is international and open to a lot more countries. So that's really great. I've not used TradeStation. I unfortunately can't give an opinion on that. Do you average to trade? Are you talking about average down? No, I tried to not average down. I've talked about in the risk management about why I don't average down, but I will have a live session on averaging down because averaging down is not for primarily day trading, it's for swing trading. So we'll talk all about that, and I even talk about the whole day trading aspect of it and when it makes sense, when it doesn't make sense for me. Nerd alert? I know, bro. For real. Yeah. So if the doctor freaking says it, you know it. How old am I? I'm 30. I'm 24. Can you drop us some books to read? Yeah, not today though. I'm too hungry and tired. What do you think of breakout wedges trading? Not sure if you answered. I did answer that, but I'll answer it again. Another thing. Getting to us right now. Yeah, it's easy. How do you hedge your positions? JP, did you already have a live session on this?
Huh?
How to hedge your positions? Do you have a live session on that yet?
How do I what?
How do you hedge positions? Do you have a live session on that already?
I haven't done that before, but that's something that we can definitely do.
Yeah, so you can see here, I still have uploads we need to do. We have VWAP, how I use Thinkorswim, MOO and MOC, liquidity that Tom talked about, line charts, JP talked about, EMAs and SMAs, day trading with, oh wait, didn't I post day trading with, yeah, I did, so I can actually delete that. And then we have bonds. I don't even want to open up this video because I don't even know what that video is. It scares me to open up videos I don't know. Alright, but I think that's it. Wait, there's main chat. Oh, thank you. Yeah, I appreciate that. Alright, I'm gonna call it wraps here. Dixie, that's unfortunately a very complicated question. But very simply, if I were to answer in one sentence, a hedge is where you had to acknowledge that you're capping your profits, which theoretically means that if you're looking at your calls or your original position at a delta entry point, if your call is 40 delta, if you're going to take a put on the same stock, even though that's not a correct hedge, but let's say you are, your delta cannot be the same. It can't be 40 delta because then that's just a straddle at the point. So you're basically, what I mean is, if your original position runs, that should be a lot more profitable versus your hedge should be like a little bit more out of the money, kind of like that, higher risk, high reward kind of thing. Anyway, we'll go over that another day. Appreciate it. Thanks for you guys coming on. See you guys later. Peace. See you, JP.